right, so the market's 5-day losing streak is finally over. But the big question is, was today's bounce for real? We're going to break down everything that happened in the January 12th session to figure out what's what and what might be coming tomorrow. And that really is the million-dollar question, isn't it? After 5 straight days in the red, we finally get a rebound. But is this the start of a real recovery? Or are we just looking at a classic bull trap? Let's dig into the data and find out. You know, to get the real story, you've got to look past the headlines. We're going to uncover the forces that actually move the market, check its underlying health, and then piece together a clear trading plan for tomorrow. Okay, first things first, the headline news. The 5-day losing streak has officially been snapped. Both the Sensex and the Nifty closed in the green, finally giving the bulls something to cheer about. The Sensex jumped a solid 302 points, closing the day at 83,878. It's clawing back some of those losses we saw last week. And the Nifty 50 also had a good day, closing up 0.42%. So what was the fuel for this rebound? Well, a recovery like this doesn't just happen in a vacuum. There were actually 2 key factors today that gave buyers the confidence to step back in. A huge driver was the return of big money. Foreign institutional investors, the FIIs, they completely flipped the script. They became net buyers, pouring nearly 1,800 crore rupees into the market. Now that is a major shift in sentiment. And it wasn't just the FII buying. Positive global cues helped a lot too. We heard some really optimistic comments on India-US trade relations, and that gave investors just the kind of confidence boost they needed to start buying again. But here's where the story gets a little more complicated. If you just look at the index gains, you're not getting the full picture. When we dig a little deeper, we start to see a mix of both strength and, well, some pretty significant weakness. See, the market breadth tells a totally different story. For every 1 stock that went up today, nearly 2 went down. What this means is that even as the big indices were rising, the broader market was still hurting. And that's a classic sign of underlying weakness. Now, on the positive side, the Nifty's chart formed what we call a bullish candle. It opened lower, but it closed near its high for the day. And that tells us something really important. Despite that weak breadth, buyers stepped in to defend the lows. That's a definite sign of short-term strength. The sectoral performance tells a pretty similar story. The rebound was really led by the metals and mining space. You see stocks like Coal India and Tata Steel having strong dates. But on the flip side, the heavyweights in IT and financials, think Infosys and Bajaj Finance, they continued to lag behind. So, what does this all mean for tomorrow, January 13th? Let's put all the pieces together and build our forecast. You know, given all these mixed signals we saw today, the outlook has to be cautious. We're probably looking at a flat, maybe even a slightly negative opening. I think the market will likely trade within a pretty defined range as the bulls and bears kind of battle it out for control. And there are a few key things you've got to keep on your radar. First, will the FIIs keep buying, or was today just a one-off? Second, we've got major IT earnings coming up from giants like TCS and HCL Tech. And on top of all that, we have important inflation data on the way. Any of these could easily swing the market. Okay, for all you traders out there, knowing the key price levels is everything. Let's break down the most important zones to watch for both the Nifty and the Bank Nifty. For the Nifty 50, you're going to want to keep a close eye on immediate support right around 25,650. If that level holds, the next hurdle is resistance up near 25,900. But I gotta warn you, if that support breaks, the next stop could easily be down at 25,400. And for the Bank Nifty, the critical support zone is that band between 59,000 and 58,700. Holding that is absolutely key. On the upside, you've got resistance near 59,500. A break below that support would spell more trouble for the banking sector, for sure. So how in the world do you trade a market like this? Let's distill all of this analysis down into a simple, actionable strategy for tomorrow. All right, step 1. The core strategy is to stick to the classic buy on dips and sell on rallies. Don't go chasing the highs. Step 2. Be selective. Focus on the sectors that are showing some strength, like metals, PSUs, and some of the consumer stocks. And finally, step 3, a word of caution. It's probably best to avoid the more volatile, high beta mid-caps for now. You know, the ones that swing wildly with the market. Let's wait for a clearer trend to emerge. And that brings us right back to where we started. Yeah, today's rebound was nice to see, but with all that underlying weakness and major events right around the corner, the market is still on pretty shaky ground. The main takeaway here is to be cautious. So, what's your call for tomorrow? Bullish or bearish? Let that question guide your trading plan.